So in today's lecture, we will start a new topic, which is your last topic. The topic is a cost analysis for decision making. The topic title is topic 5. Topic 5. So the topic is a cost analysis for decision making. Can you hear me? Can you hear me now? Okay. Okay, so in this topic, we're gonna study 1 to 3 different things in this topic. So let me give you the overview of this topic, then we will start covering things one by one. So in this topic, first of all, you will study about cost allocation methods. Cost allocation method. So we have 2 types of methods related to cost allocation, right? So these 2 methods involve a marginal costing, and absorption costing. Marginal costing and absorption costing. So we have 2 different methods here. I hope you remember your I think second topic, which in that topic we discuss about the different types of cost by behavior and cost by function, or cost by operations. So under absorption costing method, we allocate cost by functions, right? So allocate cost by functions or by operations. By operations, right? Or by function, same thing, operations or functions. So company has mainly 2 different functions, manufacturing and non-manufacturing. Same thing, operations. Operation means related to product and service. So product and service have 2 different types of cost, manufacturing or non-manufacturing. So that's why allocation by operations or by functions. Second second types of cost we study in our topic 2 was by behavior, right? By behavior. Under by behavior, we divided cost into 4 different parts: fixed cost, variable cost, semi-variable cost, and step cost, right? So on an average, if you have a look, if you want to calculate the total cost is a combination of 2 types of cost: fixed cost and variable cost. We may not really consider step cost or semi-variable cost, because step cost and semi-variable cost are not very common costs that occur in every kinds of business. However, fixed and variables are very common cost. So that's why when we are estimating the total cost by behavior, we focus more on only 2 types of cost: fixed and variable. So this is your marginal costing. So you will study how we allocate the cost under absorption costing, which is by behavior, and how we allocate cost under marginal costing, which is by behavior, right? By operations and by behavior. And then after allocating the cost, we estimate profit. How much will be the profit when a company is applying absorption costing method? right? And what will be the profit when company applying marginal costing method to allocate the cost. So this thing we will study in this topic. So this is the first thing we will study, which is cost allocation method. Second thing we will study in this topic, this is second thing we will study about cost volume profit analysis. Cost volume profit analysis. In this cost volume profit analysis, you will estimate, so cost volume profit analysis, another name of cost volume profit analysis is, we also call it break-even analysis. We also call it break-even analysis. So under, what is the meaning of break-even analysis? Break-even analysis is a situation when your sales is equals to the cost, which means no profit, no loss. So that situation is called the break-even situation or break-even point. So we're gonna analyze this break-even situation by considering sales units. So which means how many sales unit we have to sell if you want at least break-even. If you're saying this is your break-even sales units. If your sales units go below break-in points, you have a loss. Go above break-in points, you have a profit. So it's very important to estimate the break-even points. So which basically tells us minimum units we need to sell if we want to stay in a market or if we want to survive in a market. All right. So this is called the break-even analysis. So you're gonna study two different things: sales in break-even units and sales in dollar break-even. Right? Break-even sales in units and break-even sales in dollars. And of course, we will have a look some kinds of graph to identify how we can estimate, how we can find the break-even situation where company will not have any profit or any loss. Right? So yes, so we will study this cost volume profit. And the third thing that we will study is a different decision making. Different decision making. Different decision making means company has to make different kinds of decision making in organizations. All right. And what decision makings are, first of all. So like, for example, I'm just going to give you a quick example. For example, there are two kinds of we call it subsidiaries, two kinds of units or two kinds of department or two kinds of segment of one company. Let's say one branch, or you can say two branch, make it simple. So for example, one manufacturing companies or non-manufacturing companies or any kinds of company has two branches in Vietnam, for example. One branch is in Ho Chi Minh City and one branch is in Hanoi, right? So, and Hanoi branch, for example, is having a loss, which is under loss. So now the question is, if Hanoi branch is in the loss, should we continue or should we discontinue? Means we should keep going on with that under loss branch, or we should stop that branch, right? If you look at generally, you will say that yes, of course, we should close down that branch because that branch having a loss. But in reality, that's may not happen. Means before we making a decision to close or to continue that branch which is in loss, we have to analyze. We have to come up with the conclusion whether we should. So I mean, we have to identify different types of cost. By analyzing different kinds of cost, by analyzing the overall revenue of the companies, which is Hanoi plus Ho Chi Minh City, then we will come up with the conclusion that we should continue or we should not continue. We should not make our judgment on behalf of the single branch performance. What is the contribution of that branch in overall business? Because if you discontinue that branch, you may lose the market share, you lose the customers, and of course it will give some kinds of negative impacts on the business, on the customers. So as a result, the customers in the Ho Chi Minh City, the customer who buy a product from Ho Chi Minh City branch which is in profit, customer may stop buying that product from that company. Employees start leaving your company. So there are various reasons. So the idea is that before making any kinds of quick decision, we have to analyze it. We have to analyze the cost. And after analyzing the cost, then we will decide, yes, we should continue or we will discontinue. So we have 5 different kinds of decisions that company has to make it. Right? So you will study that 5 different types of decision. So that's the whole idea for this topic. So these 3 points are related to the cost. If you have a look, your first point, which is a cost allocation method, that's of course, it's about the cost. Second is a cost volume profit analysis. That's also about the cost. And third is a different decision making. So means we estimate, we analyze the cost in order to make the various kinds of decision in an organization. And of course, we are looking at the cost. So that's the whole idea of this topic, which is cost analysis for decision making. All right. So let's start with the cost allocation. I think I should sign out and then sign in because just 2 minutes left. So let's start with the cost allocation method. Okay. So I repeat something that we have studied before. So this is recall few things, you know that, which is sales minus cost. Sales minus cost is profit. Profit. All right. I remember one thing. Cost means total cost. All right. Cost means total cost. So sales minus total cost is a profit, right? You know that. Now, cost allocation method. Allocation means divide, right? Apart. So cost allocation method. So we have 2 different methods who allocate cost differently. All right. So I repeat here. Under cost allocation method, we have 2 methods that I talked earlier, marginal costing and absorption costing. Remember? So under cost allocation method, we have 2 methods which allocate cost differently. Allocate cost differently. Why differently? As I said, one, we study by behavior, right? By behavior or by functions? Can you please remind me? When I explained to you regarding types of cost under topic 2, remember manufacturing and non-manufacturing? I think by operations. Yes, by operations. So we allocate cost. We allocate cost differently. 2 methods. Right? We allocate cost differently. What is that? One is by operations. We allocate, and allocate by operations and by behavior. Right? By operations, by behavior. Now, you know that by operations, cost divided into 2 parts, manufacturing and non-manufacturing. Manufacturing cost, right? and non-manufacturing cost. Non-manufacturing cost, right? Manufacturing cost and non-manufacturing cost. By behavior, cost divided into by behavior. So by behavior, cost divided into two parts: variable cost and fixed cost. Variable cost and fixed cost. All right. So now have a look at your manufacturing cost. Manufacturing cost is a combination of three types of cost. I hope you remember that, which is direct material, right? Direct labor, right? And overhead. Direct material, direct labor, and overhead. So now keep in your mind that direct material, direct labor is a variable cost, right? If you do not remember, so you go back to your topic 2 and you check again, right? Variable cost. Direct material, direct labor is a variable cost. And overheads, overhead means depreciation. For example, rent, right? Maybe supervisor. Supervisor is a semi-variables, or it's a step cost, but as I said, we will classify cost into two parts, variable and fixed. So we ignore the step cost and semi-variable. So supervision also part of your fixed cost, right? So overhead is your fixed cost. All right, that's also your fixed cost. So means idea is that manufacturing cost divided into further two parts. You can say that manufacturing cost divided into further two parts, which is variable cost and fixed cost. All right. Same thing, non-manufacturing cost. What inside non-manufacturing cost? Non-manufacturing cost involve marketing and advertising, right? Transportations, right? Maybe R&D, research and development, right? And packaging and labeling, R&D, packaging and labeling, right? And maybe some other administration cost, right? Administration cost means the salary of the office staff, right? Administration involved the depreciation for office, rent for office, insurance for office, right? So these are the appreciation cost, administration cost. Now, these non-manufacturing cost, you can also divide into two parts, which is variable and fixed, same like as manufacturing cost, all right? So you can divide into another two parts like this: marketing, advertising, Transportations, R&D, packaging, labeling, these types of cost are variable cost. Why? Because if you want to sell more product, you do more marketing, more advertising, right? Transportations. If you sell more product, you have to spend more money on transportations. You have to spend more money on delivery, logistics, right? Supplying product to the distributors or supplying product directly to the consumers, right? R&Ds. If you require further innovations or creativity in your product, you have to spend more money on research and development. Same thing, packaging and labeling. If you want to sell more product, let's say you produce more, to sell more, you have to spend more money on packaging and labeling, right? So that's why packaging and labeling your variable cost. So marketing, advertising, transportations, R&D, these are non-manufacturing variable cost, right? So these are variable cost, right? And office staff, depreciation, rent for office, insurance for office, all these kind of cost is your fixed cost, right? It's your fixed cost. So that's the whole idea by operations. Remember one thing. So one thing I want to emphasize here is that cost is divided into two parts, which is manufacturing and non-manufacturing, all right? Manufacturing and non-manufacturing. That's the two parts of operations, not variable, not fixed, all right? Under operations, like as by operations, the cost of this product divided into two parts, manufacturing and non-manufacturing, right? And under manufacturing, we have variable fixed. And under non-manufacturing, we have variable fixed. But overall, this pen has two types of cost, manufacturing and non-manufacturing, right? That's the idea for operations or by operations, all right? And for variable, if you have a look at the variable behavior, by behavior, variable cost divided into two parts, manufacturing and non-manufacturing. Manufacturing variable cost and non-manufacturing variable cost, right? So variable cost involve manufacturing, right? Manufacturing cost, right? And non-manufacturing cost. Non-manufacturing cost. So what could be variable manufacturing cost? What could be variable manufacturing cost? Variable manufacturing cost is direct material, direct labor. All right? Direct material and direct labor. Direct material, direct labor, or direct expense. So these are your variable manufacturing. And what could be variable non-manufacturing? Variable non-manufacturing is variable non-manufacturing, which is marketing, advertising, transportations, R&D, packaging here, all right? So these are variable non-manufacturing. Same like as variable, fixed cost also divided into two parts, fixed manufacturing and fixed non-manufacturing, right? Which is fixed manufacturing cost and non-manufacturing cost. Manufacturing cost and non-manufacturing cost. And what could be fixed manufacturing cost? Fixed manufacturing is an overhead. So fixed manufacturing is an overhead. Rent for factory, depreciation for factory, insurance for factory, supervision, which is maybe indirect labor, and you pay them fixed, right? So that's your fixed manufacturing, right? Fixed non-manufacturing, which is here. Fixed non-manufacturing, which is administration, salary of office staff. Again, depreciation, insurance, and rent for the office things, right? So that's your fixed non-manufacturing, right? So now the idea is that by behavior, cost divided into two parts. So by behavior, the cost of this pen divided into two parts, variable and fixed, right? Variable and fixed is the total cost of this pen by behavior, all right? And by operation, manufacturing and non-manufacturing is the total cost of this pen by operations, all right? So remember this thing. So variable and fixed, right? So by behavior, cost divided into variable and by behavior, variable and fixed. So the idea is that by operations, total cost, so by operations, total cost is manufacturing cost plus non-manufacturing cost. All right, according to operations. And according to behavior, your total cost is variable cost plus fixed cost. All right. So the idea is, the conclusion for this discussion is here, this one. This one. This is your cost, right? This is your cost. So sales minus cost is profit. All right. Sales minus, this is cost, right? This is cost. So sales minus this cost. This cost means cost by operations. So sales minus cost is profit, right? And same thing here, which is this. So sales minus cost is profit. So that what you're gonna do here, you will calculate profit when you apply this operations method, right? And you calculate profit when you apply this behavior method to calculate the cost, all right? We don't call it operations method or behavior method. The word operations and behavior, we use it to allocate the cost, all right? But it has a name. When you use operations to allocate cost to estimate profit, this is called absorption costing, all right? This is called absorption costing. When allocation by operations calculate profit, right? So absorption costing. Absorption costing, right? And by behavior, it's a marginal costing. So that's what I mean here. Two different methods. We have two different methods which allocate cost differently, right? We have two different methods who allocate cost differently. Two different method means absorption costing and marginal costing. So under cost, so now the conclusion is we estimate profit in a two different way. One is we estimate profit by applying absorption costing method, which believe that cost divided into two parts, manufacturing and non-manufacturing. All right. Central idea for absorption costing is a manufacturing and non-manufacturing cost. And marginal costing central idea is a variable cost and the fixed cost. So under marginal costing, we estimate profit by allocating cost into variable and fixed. So this is the overall idea to calculate profit for marginal costing using marginal costing and absorption costing. All right. So did you understand? Did you get the ideas of two different methods? Any questions? If you have any questions, anything is unclear, you ask me. If no questions, then we move on to the calculations. I mean, but before calculation, I have to speak about absorption costing a little bit more. So we will talk about absorption costing first. We will have a look how absorption costing help us to estimate the profit, because this is not the done. I mean, this is not done yet. Your calculation, it's just an idea, right? But we're gonna have a look one by one now how we can systematically apply or estimate profit. Non-manufacturing cost, please. I can't understand marketing and advertising. Okay. Student asked me, can you teach again non-manufacturing cost? So I think you have to go back to your topic 2. I already covered in your topic 2 when we discuss about the types of cost. In that types of cost, yes, it's a marketing and advertising. It's a marketing and advertising. MKT stands for marketing and ADV stands for advertising. In order to understand marketing and advertising, you have to go back to topic 2. But the general idea is that if you want to sell more product, how can you sell more product? You can sell more product by telling customer, this is your product. So how can you inform customer? How can you tell customers what options you have available? One option, which is only one option, which is marketing and advertising. That's why all companies, whenever they launch any product, whenever they produce new product, they always do marketing for that product. Let's take example of iPhone, Apple, iPhone 12. So when company finish iPhone 12, company open a seminar or whatever, but that's also mode of marketing, right? So company open seminar to inform the consumers about the product features, right? Product applications, so new things about that product. And what Apple is doing, again, they're doing marketing, right? Same thing with the other companies. They also do the same thing. That's the meaning of marketing advertising. You do more marketing, you sell more product. You do less marketing, you sell less product, right? Next week, Monday, yes. So this is the last online class. No more online class because, as you know that, according to university rule, we can have a maximum 3 online classes. All right. So this is the 3rd online class. 2 online classes we already finished. So next class will be in the school, right? So not online. Monday I'll see you. Monday means tomorrow. I'll see you in the class, right? I mean in the university. Okay, so any questions, or we now we have a look absorption costing. Can we move on to absorption costing? Tell me, can we move on to absorption costing? Can we start absorption costing now? Okay. So absorption costing. Another name of absorption costing is a full costing. Full costing. Why we call it full costing? Because absorption costing believe that both fixed and variable, both fixed plus variable, are part of manufacturing. So both fixed plus variable. Fixed plus variable is a total cost. Total means full cost, right? Full means total cost, and total cost is fixed cost plus variable cost. So it means both fixed and variable cost are part of manufacturing according to absorption costing, and if that's true, you can have a look here. So make sure you take a picture of this one. Of course, I'm recording this session, but I think you need to have a look this information again and again. So better you take a picture and keep in your phone. So whenever I ask you something, you just have a look and then you answer my questions, right? Okay, so you can see here manufacturing cost. You can see both fixed and variable part of manufacturing cost, right? Not just only variable or not just only fixed. Both belongs to manufacturing, like as direct material, direct labor, which is variable, and overheads, depreciation, rent, insurance, supervisors. These costs are fixed cost. Right? That's the idea here. So how we calculate profit under absorption costing? Right? So let's have a look here. So we have sales minus manufacturing cost, right? Sales minus manufacturing cost. Can you tell me what is the another name of manufacturing cost? Topic 2. My question is, what is the another name of manufacturing cost? Tell me. Another name of manufacturing cost is a cost of goods sold. All right. So sales minus cost of goods sold is what? Anybody knows? Sales minus cost of goods sold is, or sales minus manufacturing cost is gross profit. All right. So sales minus cost of goods sold is a gross profit minus non-manufacturing cost. Non-manufacturing cost. Non-manufacturing cost is a net profit. It's a net profit. It's a net profit. Right? So how to calculate sales? You know that, how to calculate sales. Sales units, selling units, or sales units. So let's say selling units multiply by selling price per unit. That's your sales. That's your total sales. All right. Now, cost of goods sold. In order to calculate cost of goods sold, we have a formula to calculate cost of goods sold. What is the formula? The formula for cost of goods sold is so here is a cost of goods sold. So how to calculate cost of goods sold? So here, cost of goods sold, manufacturing cost per unit, manufacturing cost per unit, all right, multiply by this. Multiply by this. So what is this? This is opening inventory right, plus purchasing. Opening plus purchase is available, right? Opening plus purchase is available. This is your available. Inventory is available. Minus closing inventory. And that's your cost of goods sold in units, all right? Cost of goods sold in units. So that's your cost of goods sold in unit. So cost of goods sold in units. Did you remember opening inventory and closing inventory? Yes or no? Did you remember opening and closing inventory? Say something. So can you please explain to me what is opening and closing inventory? Just to make sure that you know the right idea of opening and closing. Please explain to me. Tell me, what is the difference between opening and closing inventory? Number of inventory, the start of the day is the opening inventory. Okay. And what is closing? Closing is at the end. Yes, that's right. So can you tell me where opening come from? Where opening inventory come from? End of the yesterday. All right, so remember, yes, that's right. Remember, today's closing, tomorrow opening. Tomorrow closing, next day opening, right? So this week closing, next week opening. This month closing, next month opening. This year closing, next year opening. All right. So you need to know that. All right. Because sometimes you have to calculate net profit or you have to calculate cost of goods sold for 2 different months, let's say January and February. Right? So when you are calculating the cost of goods sold, when you calculate cost of goods sold for January, so you will see last year December, do you have any opening or not? If his opening is, sorry, closing is 0, December last year. So this year, which is January opening will be 0. So we directly start with the purchase. So purchase, which is also available, minus closing, this is your cost of goods sold in units. So once you got cost of goods sold in unit, this cost of goods sold in unit, you will multiply by manufacturing cost per unit. How to calculate manufacturing cost per unit? Anybody has any idea? Manufacturing cost per unit? What is manufacturing cost per unit? Quickly tell me, and then we move on. How to estimate manufacturing cost per unit? Manufacturing cost per unit is direct material per unit, direct material per unit plus direct labor per unit plus overhead per unit. So that's your manufacturing cost per unit, right? So manufacturing cost per unit multiply by cost of goods sold in units, that's your cost of goods sold. All right? Everybody understand? All right, so this is the way to estimate your cost of goods sold. One thing I need to explain you that I may forgot last time to explain to you. So remember, opening plus you can call it purchase if you're talking about raw material. You can call it production if you talk about the finished goods, right? So generally we use the word production because cost of goods sold means we sell only finished goods. We don't sell raw material. For example, raw material is not our product. Our product is the finished goods, right? So we have to calculate the cost of finished goods, that the finished good that we are selling. That's the meaning of cost of goods sold, right? Cost of goods sold. Which goods we sell? Finished goods we sell. Finished goods means production. So opening plus production, right? Opening plus production is available inventory minus closing. Whatever is left, that we sell it. So we calculate the cost, which is here, something we sell it according to matching principles, your financial accounting. So this is the way to estimate your gross profit, and minus non-manufacturing cost. And you know that non-manufacturing cost, we don't have a specific way or methods to calculate non-manufacturing cost. Generally, non-manufacturing cost is given in your question. All right. One more thing I need to confirm you. I hope you know that, but in case you don't know, so let me confirm you. So you know that manufacturing cost is a combination of three types of cost: direct material per unit, right? Direct labor per unit, and overhead per unit. So that's your, it's become your manufacturing cost per unit, all right? And please note that this overhead cost is a combination of two types of cost, all right? This overhead is a two types of cost. Which two types of cost? Variable overheads, variable overhead cost, and fixed overhead cost, right? Variable overhead and fixed overhead. Variable overhead generally given in units. So you don't have to calculate variable overhead per unit. Variable overhead, so always remember variable cost generally given in units, right? Because if unit increase, cost increase. So variable cost generally given in a unit, fixed cost generally given total, because number of units do not affect fixed cost. So that's why we always measure or disclose fixed cost as a total. I mean, in a total for year. So generally for year. If you have fixed cost total, then you have to convert fixed cost into per units. So you have fixed cost per unit, variable cost per unit, called overhead cost per unit, all right? So you need variable cost, variable overhead cost per unit, and a fixed overhead cost per unit, right? So remember that. That is the way to calculate your cost of goods sold, right? So as I said, non-manufacturing cost is very straightforward, is given in your question. You just simply have to add all the non-manufacturing costs is given. Generally, marketing and advertising is one of the common non-manufacturing costs which is given in your question. You're not going to be confused by identifying which one is manufacturing and which one is non-manufacturing. It's very clear. Marketing, advertising, obviously non-manufacturing, and material, labor, overheads. This is your manufacturing or cost of goods sold, right? So this is the way to estimate your profit under absorption costing, all right? Now, let's move on to the question. Remember last time, today in the beginning of this lecture, I send you file. So please ignore that file because that file is incomplete. So now I completed that file and I'm gonna send you a new file. So you save this new file. So, so question 1, 2, and 3. So we will do all these three questions one by one. All right. So all these three questions is about marginal and absorption costing. So as you can see. So you will calculate profit using absorption costing first because I haven't explained you about marginal costing. All right. So you do it absorption costing for question 1, right? And absorption costing for question 2 and absorption costing for question 3. And once I finished marginal costing, and then you will do marginal costing for question 1, 2, and 3, all right? All right, so let's start with the question 1. So we did the question 1 first, and then we calculate. Okay. So Mesa is planning to manufacture. Mesa is planning to manufacture a new vehicle for use in a farming industry. The company expects the following unit cost and sales to apply to the new product. So we have selling price, which is 11 pounds. Selling price per unit, 11 pounds. Now we have variable cost per unit. So direct material, £2, direct labor, £2, variable factor overheads or variable overheads, which is £1. So total variable manufacturing cost is a £5. So all these are manufacturing cost. So variable manufacturing cost is a £5. Now fixed cost per unit. Fixed factory overhead is a £108,000. Normal production for the year in a unit is 36,000. So means normally our production capacity is 36,000. So 108 divided by 36, which is shown very clearly, £3 is the fixed cost per unit. And obviously this is fixed manufacturing cost, right? So as it said, fixed factory is a manufacturing, right? So fixed factory overheads, it's a manufacturing cost, which is 3, right? Now we have 3 different months. January, we produce 3,000, sold 1,500. February, produce 500, sold 2,000. March, produce 4,000 and sold 2,000, right? So we assume there is no opening inventory for January. So January opening is 0. So opening, which is 0, plus produce, which is 3,000, right? And how much is closing? How much is a closing inventory? How much is a closing inventory? $1,500. So opening plus produce less closing, it's your cost of goods sold, right? And January closing will be February opening. So opening plus 5,000 less calculate closing for February and then check, right? So calculate profit for January, February, and March. All right, so you're going to calculate profit like this. So absorption costing. So January, February, and March. So that's for January, February, and March. So you're going to do sales minus cost of goods sold, gross profit minus non-manufacturing cost. It's a net profit. We don't see any non-manufacturing cost here. So we assume non-manufacturing cost will be 0 for 3 different months. All right. So now calculate net profit for January, February, and March. All right. So calculate. Okay, so let's start with the question 1. Right. So in question 1, first of all, you have to calculate sales, which is sales units multiplied by selling price per unit. Price per unit. Right. So tell me, how much is the sales for January? Tell me, sales for January. 1,500. How did you get 1,500? $16,500. That's right. 16,500, not 1,500. 1,500 are only units. You have to multiply by price as well. So January sales is 16,000. Yes, 16,500. Now sales minus cost of goods sold. So for January, you need to calculate cost of goods sold. So the formula is opening plus produce less closing and multiply by manufacturing cost per unit. Right? So opening is 0, right? How many we produce? Sorry, how many we produce?
3,000.
I can't hear you very clearly. 3,000. We produce 3,000 units. So we produce 3,000 units. And the closings are? How much is closing? 1,500. 1,500. So cost of goods sold units are 1,500. Multiply by manufacturing cost per unit. So manufacturing cost per unit is direct material, direct labor plus overheads. So how much is the direct material? Direct material is 5. Direct labor 2, and overheads variable and fixed. How much is variable? 5 is total. Direct material is 2. Direct labor 2. How much direct labor? How much is direct labor? Say something. Direct labor also 2. Okay. And overheads? 1. Overhead is 1. Is it overhead or is it variable overhead? One is a overhead or one is a variable overhead? We need overhead. So how much is total overhead? Total overhead. No, total overhead is not 1. Total overhead is 4. Yes. Total overhead is 4. So your manufacturing cost per unit is 8 pounds, right? So cost of goods sold is how much is cost of goods sold? 12,000. That's right. 12,000 is the cost of goods sold for January. Right. So gross profit is 4,500. And non-manufacturing cost is 0. So profit is 4,500 for January, right? February, calculate profit for February and calculate profit for March and tell me how much. Calculate profit for February and March. $6,000. 6,000 profit. Everybody got 6,000 or anybody got different answer? Everybody got 6,000 or you got different answer? $6,000. And how much is a profit for the month of March? How much is a profit for the month of March? So that's your February and March. March also 6,000 profit. March also 6,000. So let's check for sure. That's that. So now you said 22,000. 22,000 is 16,000. Oh, I don't know. So maybe you don't understand me. Okay, anyway, let's calculate for February. How much is the sales for February? Sales for February. Tell me sales for February. Sales is 22,000. Okay. And cost of goods sold for February? February cost of goods sold. Opening, how much is opening for February? Opening stock? 1,500. Yes. And how many we produce? 500. And how much is closing? 0. Yes. So 2,000 multiplied by 8. Your manufacturing cost will be same, which is 16,000. $16,000. So it will be gross profit 6,000. 6,000. So let's calculate for the month of March. How much is the sales for March? Sales for March is also 22,000. Okay. So March. So how much is the opening stock for March? Is opening inventory for March? 0. Yes. And how many we produce? 4,000. And how much is closing? 2,000 is the closing. So produce is 2,000. multiply by 8, which is 16. That's also 16. So which is 16. So that's 16. So that's your 6,000. Non-manufacturing cost is 0 and profit is 6,000, right? So that's your profit for 3 months. All right. So that is the profit following absorption costing. All right. Now, that's all for this lecture. But before we stop, I want to give you homework. So your homework is question 2 and question 3. Question 2, absorption costing, right? And question 3 also absorption costing. So tomorrow I will check your these 2 questions. So let's have a look at question 2 and question 3 quickly. What inside question 2 and question 3, and then we will stop. So question 2, it says that, so question 2, it says that RCL is planning to manufacture a new chemical for the use in a farming industry. So again, it's some from farming industry. The product will be sold for 30 pounds per unit. So that's your sales, 30 pounds per unit. Company expect the following unit cost to apply production of chemical. Right? Ingredients 1, ingredient 2. Ingredient means this is your raw material. So you have a 2 raw material or 2 direct material. Right? So direct material and direct material. Half kilo price is 3 pounds per kilo. So make sure 3 multiply by 0.50 and 4 multiply by 0.75. All right, so that will be direct material. So you have 2 direct material, 1 and 2. Right? Labor. Your labor is 5 pounds per hour. And labor work, let's say 0.5 hours. So 0.50 multiply by 5. So that will be your direct labor, right? And that's your variable overheads, which is 0.50 multiply by 8 pounds, so which is 4 pounds. All right, this is your variable overheads. So you got material, labor, and variable overheads. Fixed overhead are expected to be 15,120 per annum. Per annum means per year, right? Will occur evenly over the each year, right? Each 3 months period is assumed to contain the same number of days, and production and sales will be same as for 3 months period. So of course, if you are calculate anything for 3 months or something, so remember, this is 15,120 is for 1 year. If you are calculating for January, you have to divide it into 12. So you have a 1 month. You have a monthly fixed cost. And that's for your January. And same for February, same for March, because fixed cost will be fixed for every month, right? Monthly. Okay. The planned production sales level for the first 3 months of 2014 are expected to be January, February, and March. This is production, this is sales, production, sales, production, sales. The company held no inventory of raw material or finished goods on January. So means January, we do not have any opening. No opening for January. All right, so same like as question 1, right? So this is your question 2, only absorption costing, because I haven't finished marginal costing. So just calculate net profit using absorption costing for 3 months, all right? For 3 months. So for 3 months. So that's your question 2, right? Now let's move on to question 3. Question 3 is the following data has been extracted from the budget and standard cost of DLF Private Limited, a company that manufacture and sell a single product. So we have a selling price per unit, which is 45 pounds, material 10 pounds, labor 4 pounds, and variable overhead 2.5 pounds per unit. Fixed production overhead costs are budgeted at 400,000 per year, per annum, right? It's for 1 year. Normal production level are thought to be 320,000 units per annum. So what does it mean? Same like as question 1. If you want to calculate fixed cost, fixed overhead per units, then 400,000 divided by 320. So it's gonna be around 1.25, I guess. Yes, you can check. So that will be your fixed overhead per units, fixed overhead. Variable overheads, we already have 2.50. Don't forget to add fixed overhead per unit. Budgeted selling and distribution cost. Now in this question, you have a selling and distribution cost, but if you have a look, question 2, we do not have any information about non-manufacturing cost. So for question 2, obviously non-manufacturing cost will be 0, right? For question 3, this is your non-manufacturing cost here. That's your non-manufacturing cost. Right. Non-manufacturing cost. This is per units, unit sold, and fixed for 1 year, right? So it depends for how many months you are calculating or what, we will check later. Now, following pattern of sales, production is expected during the first 6 months of the year. So here, you are calculating from January to March, first quarter. This is quarter 1, and this is quarter 2, right? So you are calculating your sales for first quarter, production, first quarter. First quarter, second quarter, all right? So we assume there is no any opening for first quarter. So no opening inventory for first quarter, for quarter 1, right? No opening, right? So same like as the previous other 2 questions. You have to calculate absorption costing. You have to apply absorption costing to calculate profit for each quarter. All right, calculate profit for each quarter. All right, so that's your question 3. All right, so that's all for today's lecture. So anybody has any question? Question 3 again, full question 3 again. That's your question 3. That's your question 3. I already sent you the file. You can open your file. If you cannot see here, you're supposed to open your file. The file I sent, this file, I already sent it to you. Right, so you save that file in your system, in your computer. So any question regarding question 1, question 2, or question 3 for absorption costing? Emmy, any question or we stop here? No questions. All right.